What if you could own a small part of companies like Apple or Tesla without being a billionaire? That's exactly what the stock market allows you to do. Welcome to Decode Advanced English on Wealth by Hana House, where English meets finance, investing, and real-world thinking. Most people think the stock market is complicated or even risky, but in reality, it's one of the most powerful ways to build long-term wealth. Today, we'll break down a simple but powerful idea: how the stock market actually works and how investors make money from it. To understand this concept clearly, let's listen to our experts, Alastair and Victoria.
At its core, the stock market allows individuals to invest in companies.
Indeed. When you buy a stock, you are purchasing a small ownership in a company.
This means that as the company grows, the value of your investment may increase.
Quite right. Investors can benefit in two main ways: capital appreciation and dividends.
Capital appreciation refers to an increase in the stock price over time.
And dividends are payments made by companies to their shareholders.
However, it is important to understand that stock prices can fluctuate.
Which is why successful investors often focus on long-term growth.
So, investing in the stock market means owning part of a business and potentially benefiting from its growth. But how does this idea work in everyday situations? Let's listen to Liam and Sophie.
I've always thought the stock market was only for experts.
A lot of people think that, but it's actually more accessible than ever.
So when I buy a stock, what am I really buying?
You're buying a small piece of a company.
So I become an owner?
Exactly, even if it's just a tiny percentage.
And how do I make money from that?
Two main ways. If the stock price goes up, you can sell it for a profit.
That's capital gain, right?
Yes, and some companies also pay dividends.
So I can earn money even if I don't sell?
Exactly. That's why many investors like long-term investing.
But what about risk?
Prices go up and down, but over time, strong companies tend to grow.
So investing is not about quick profit?
Not for most successful investors. It's about long-term thinking.
Imagine this. Instead of working for money all the time, your money starts working for you. When you invest in stocks, you're not just buying numbers on a screen, you're owning a part of real businesses. And over time, those businesses can grow, generate profit, and share that value with you. Now let's look at some key vocabulary from today's lesson. Term 1. Stock. A stock represents ownership in a company. Example: when you buy a stock, you become a shareholder. Term 2. Dividend. A dividend is a payment made by a company to its shareholders. Example: some investors prefer stocks that pay regular dividends. Term 3. Capital gain. Capital gain is the profit earned when you sell an investment at a higher price. Example: he made a capital gain after selling the stock. Successful investors don't try to predict every market movement. Instead, they focus on owning strong businesses, thinking long-term, and letting their investments grow over time. In the next lesson, we'll explore one of the most important ideas in investing: value versus growth investing. You've been watching Decode Advanced English on Wealth by Hana House, where English meets finance, investing, and real-world thinking. See you in the next lesson.